Good morning, and thank you all for coming to the SEF Showcase, aka SEFapalooza. I would like to thank the staff for their work to put this together, and they've done a lot of work to organize all of this. And I'd especially like to thank my assistant, Shanice Jones, for everything she's done to bring all the pieces together and still manage my office. I'd also like to thank and recognize Commissioner Mike Dunn for his participation and interest in this panel. The SEF Showcase was born out of a meeting with Chris Giancarlo and Michael Cosgrove of GFI in early February. They came in to show me how GFI's platform functioned and how the interdealer brokers viewed integrating their technology with the new requirements under the Dodd-Frank Act. After seeing this demonstration, I was curious to see how other execution platforms might function. It occurred to me that a single meeting bringing together as many potential SEF platforms as possible to the Commission would be of great benefit to my office and the rest of the Commission and the market participants as well. And I think by today's participation there is a little bit of interest in this. I'd like to thank our technology team who are able to share this meeting with our regional offices in Chicago, New York, and Kansas City so they too can develop a better understanding of the range of platforms under development. I appreciate the strong representation of the technology providers as well as the user community at the table. It is unprecedented for the Commission to host such a large-scale market demonstration, let alone in a single day. I expect this meeting to be extremely valuable to both the Commission and the public. Today's meeting consists of two panels. Panel 1, seated here, features members from asset management, funds, pension funds, end users, swap market observers, dealers, and public interest groups. Our discussion will cover a wide range of topics from execution functionality to making the transition from OTC transactions to a regulated execution as smooth as possible. I will ask each participant to introduce themselves and give a brief summary of what they believe are the most important functions of a swap execution facility and provide any comments that they may have related to our rulemaking process. I am interested to hear from the broad range of market participants about how they will use these execution platforms, how SEFs will interact with clearing platforms, especially early on and during the transition period, and what they believe is the most important attributes of a SEF. After hearing from the participants, I will have a little open discussion to share ideas back and forth. And panel 2 will feature 17 different execution platforms that will demonstrate their functionality, discuss our rule proposal, and respond to the comments and concerns raised here on panel 1. I will provide each presenter with about 15 minutes to make a presentation and demonstrate how their execution platform works. What's interesting about panel 2 is that the Wall Street dealers are noticeably absent. I've not turned down a single entity that requested participation in this meeting, and yet we don't have a single dealer platform represented here today, and I can assure you it's not for a lack of trying. Nevertheless, I do believe we have a wide variety of different trading platforms representing a range of asset classes, including energy, interest rates, CDS, and foreign currency. I'm excited to learn more about the innovative and fresh ideas being developed in the market and how SEFs will be able to comply with our proposed rules and any other changes they may recommend. I'm eager to question our panelists as how they will attract liquidity to their platforms and whether or not they believe the proposed rules will offer a competitive playing field for all market participants. With that said, let me talk about what I believe are necessary attributes of a SEF. First, we must recognize that swap market is a different market than the futures market and has developed in a parallel fashion, and the statutes recognize their differences. I believe we need to establish both an RFQ and a limit order book in order to bring as much liquidity and standardization as possible. Second, I believe that SEFs must provide greater price transparency, but we must protect the buy-side's ability to transact sufficient size without penalty. I will not view the Commission's efforts as successful if we create a market structure that fractures liquidity or creates an incentive to utilize dark pools because our rules don't provide sufficient flexibility to facilitate on-exchange transactions. Third, I want to incentivize both the buy-side and sell-side market participants to compete for business and provide liquidity to SEFs. I believe that it's competition among market participants and sufficient liquidity that will lower spreads, not unreasonable reporting requirements. In the end, our goal must be to establish a well-functioning swap market that provides low-cost, impartial access to competitive execution facilities that commercial interests can rely on to hedge risk, whether they are a small farmer or large fund, or a multinational corporation or a regional cooperative. We must establish flexible rules to allow innovation and evolution in the swaps over time. This is not the last time we can revisit these rules, and we should not impose rules that are unworkable or will create barriers to liquidity formation. I'm really looking forward to our presentations, and I greatly appreciate everyone's participation here today. And I recognize that many people have come from great distances, so I greatly appreciate that. Before we get started, let me turn it over to Commissioner Dunn.
Thank you, Commissioner O'Malley, and let me commend you for your initiative in putting this together. This is a great opportunity. I was calling it a SEF Fest. I could pronounce that easier than SEFapalooza, but it does give us an opportunity as we're in the midst of this rulemaking opportunity to see what the industry thinks, how it's going to work, and what we're proposing makes sense and what we're proposing doesn't make sense. What Scott had said about this isn't the last time we're going to be looking at these rules, even after we have final rules, I think is the most important thing. We're here. We're going to have to go through a evaluation process to look at the efficacy of the rules that we've come out. But it's important for us to try to get it right in the first place. And this effort today of hearing what your connotations of a SEF is and how it will be operating is most important to the Commission as we go about promulgating those final regulations. So again, I want to thank Commissioner O'Malley, his staff, but also both panels for coming in here today and helping us try to get it right.
Thank you, Commissioner Dunn. With that, we're going to go into the panel. Panelists have been asked to give a brief commentary on what they believe is the important elements, and then we're going to have a little question and answer. We had a vote, Mike and I voted, and Bill lost. So Bill's going to go first, and we'll go around the room that way, and then we'll go up this side. So thank you, Bill, for your participation.
Thank you, Commissioner Maya. Thank you, Commissioner Dunn. I apologize. I did not bring good weather from California, so as a result, I get to go first. I'm Bill DeLeon. I'm Global Head of Portfolio Risk Management at PIPCO, and I'm a recovering trader. So from that standpoint, I have a little bit of experience on this. I thought in my brief opening remarks that I would talk a little bit about what's important in SEFs and how we envision these being used. Unlike the futures market, which has grown up with a limited number of instruments to be traded, that is to say there's more generic structures. There's a 10-year future, and you know what the 10-year future is, you know what month it is, and you know what the characteristics are. Swaps have grown up in a world where there is virtually unlimited number of combinations regarding them. So as we move from a over-the-counter world to a SEF world where you need to trade electronically, you will need to have certain functionalities involved. In addition to that, unlike with futures, SEFs will function in a world where there will be more complexity in terms of giving up and clearing, which we've not had in the futures market. That market, if you take Globex for example, has grown up where you execute and you clear on the same exchange. We envision a world where SEFs have a multiple of different connectivity points. It's important that the SEFs support that and allow for the connectivity to the different end users as well as the market participants to get that information and then pass it along in a clean, straight-through processing manner to allow for confirmations of trades, clearing, and no functional breaks. The other things that are very important, ease of use, and many of you are familiar with electronic platforms, and we already have in the futures world, as well as other electronic platforms for other products, a very wide ease of use. User needs have been met. We would fully expect to see similar build out of technology to do that. Flexibility will be very important as the market moves from, as I mentioned, this literally infinite possibility to what may be continued over-the-counter type structures or a move to more generic structures. And that's going to be a function as the market moves and what the price discovery process is there. I don't have a firm view on what the ultimate end result will be, but my guess is as we move to more SEF-like and more cleared, we'll wind up with fewer structures, and as a result, things will be more homogeneous. What is important, though, is that the technology and the processing on the SEFs allow for average pricing and blocking of trades that currently exist in the futures market now, as well as conversely allow what exists in the OTC market when you do large trades and then you allocate it to a large number of accounts. Many money managers, hedge funds, and even some corporations, while they trade, even though they do a trade, will not go to a single account. On the money manager side, this is especially important to understand because while PIMCO is a entity that manages money as a fiduciary, the number of accounts as a fiduciary responsibility is in the hundreds, if not thousands. So when we do a trade, it doesn't go to a single account. So this is a very important thing to have supported. Lastly, as I mentioned, we need to make sure that we have the right legal frameworks to make sure that everything's passed along from the time you do a trade to getting it executed, getting it cleared, and getting it given up. And that all has to be done timely in a manner that the documentation allows to meet all these requirements, because you want to have surety of trade and confidence that something doesn't happen in an untoward manner because you think you've done something but it's not given up correctly. Those are the major things. I appreciate you voting me negatively on the first bat, and hopefully I did well, and we'll get a good single on this for you.
Thank you. Single is taken.
My name is Gary Grimroth. I'm the Chief Risk Officer of Calpine Corporation. Calpine is the largest independent power producer in the United States, and we're also one of the top 3 consumers of natural gas in the United States annually. I'm here today on behalf of EPSA, which is the Electric Power Supply Association, whose members through the trade association represent approximately 40% of the installed generation capacity in the United States. Related specifically to the topic at hand being swap execution facilities, EPSA wants to ensure that end users are not disadvantaged either in the forms of collateral that it may use to support swap transactions in the future, or disadvantaged in any way related to the posting of bids or offers in the market. The energy swap market is a very complex marketplace with a large number of trading locations and forward tenor requirements. These locations and tenors are often non-standard. Therefore, EPSA believes that it is imperative that SEFs will provide a deep and diverse product array so that end users may transact to effectively hedge their underlying risks. I think that's a key point for us, is that predominantly we are an end user. Therefore, we are using these instruments to hedge, not take speculative positions. Therefore, it's even more important for me as a company to be able to go out to certain points specifically and get close at least to my generation, even though I know I can't get to the bus bar, but I still get to a point that actually becomes an effective hedge for me and doesn't turn speculative just by accident and by the marketplace. While SEFs can play an important role in improving transparency in the marketplace, it should be recognized that they cannot and should not replace the unique transactions that occur in the OTC markets today. Another key point as we kind of move forward with the potential regulations is this whole process of 2 things. 1, reporting. For me as an end user, if life was perfect, I would probably make the argument that a SEF becomes an SDR. And obviously I then take away that obligation that I have to report simply by doing the transaction. That would be perfect for me. The second piece is when you go down the path of bringing in potentially broadening the scope of what swaps are to physical options. That kind of is a game changer in the power industry, as we do a tremendous amount of embedded options in any agreement that we do as we supply power to retailers and the like, or a tolling agreement where effectively I'm leasing agreement out into the marketplace with a specific counterparty. That effectively is an option. Therefore, under the swap term or potential swap term, now that becomes a financial derivative to me and I need to report it. The customized terms around that, and especially when you get into locations and the like, I think there is a concern in terms of just how I keep information confidential, because they are one-off transactions. They're reported out, people find out who the counterparties are on both sides of the transaction and where that all ends up. So that's another, I think, key piece of the puzzle as we move forward. I too want to thank. I agree with Bill totally about the flexibility. That's the real crux of what a SEF needs to provide. I need more things to be able to participate in the marketplace, either buying natural gas, selling power, and the different forms in terms of tenors that they may take on. That's always going to be extremely important. So I too want to thank both of you for putting this on today, and look forward to hearing everybody's comments.
Thank you. John?
Thank you, Scott. My name's John McFarlane. I'm Vice Chairman of Tudor Investment Corporation, a Greenwich-based alternative asset manager, which manages approximately $12 billion of funds for our clients and for ourselves. Commissioner O'Malley and Commissioner Dunn, we sincerely appreciate the opportunity to participate in today's panel, and we strongly endorse the principles in the Dodd-Frank Act of increasing price transparency, liquidity, and market access. We also applaud the effort of the Commission in putting forth a set of rules that embrace these principles. Our fundamental hope is that these principles will ultimately provide the discretion that we need to manage in a most efficient way for our clients and for ourselves to achieve best execution, and we hope that the rules will not be overly prescriptive. I will reserve comments on specific aspects of the rules until later in the discussion. Thank you.
Dexter?
Thank you, Commissioner Amalia, for hosting us and promoting the dialogue. I'm sure it beats holding up in your office and reading our comment letters. The email that you sent us, and in fact in your opening remarks, you asked us to comment on, among other things, what CFTC can do to transition from OTC swap markets to regulated swap markets. And the statement seems to imply that regulated swap trading wouldn't be OTC, and you might also be suggesting that swap markets today aren't regulated. I don't want to spend a lot of time talking about regulations and regulators that pertain to the U.S. banks that are the swap dealers, but I do want to say something about the importance of OTC markets. OTC markets, as you may know, are older, larger, far more varied, as Bill pointed out, than exchange markets, and electronic fixed income OTC markets have existed for about a dozen years. They've got multiple trading styles and methods. They provide customers with high quality execution, and they provide the liquidity providers with a degree of protection. We believe that OTC markets are, in a word, necessary. CFTC has a 37-year history of regulating futures and options markets, and your expertise is unparalleled. But swaps aren't futures, as you pointed out, and SEFs should not be exchanges. We commend your comments on the need for SEF flexibility. We're all here today to help CFTC how to figure out how to take a market that's maybe 5% electronic today to perhaps 70% electronic in a few years' time. And that would be in a fraction of the time that it took U.S. Treasuries to get to that same level. So that's revolution, not evolution. And we need CFTC to be thoughtful and deliberate. Morgan Stanley's main concern through all this is the maintenance of orderly and liquid OTC swap markets for our customers. And as we indicated in our comment letter, we believe that there are several proposed rules that threaten to materially reduce swap market liquidity in the areas of RFQs, customer choice, mandatory execution requirements, block trade sizes, transaction reporting. I have a feeling we'll be hearing more about those today, and I look forward to the dialogue. Thank you.
Suparna?
I'm Suparna Vedbrat from BlackRock. I'm their business advisor for fixed income trading and market structure. Thank you, Commissioner Amalia and Commissioner Dunn and staff for inviting BlackRock to share our views on swap execution facilities. As you know, BlackRock is supportive of DFA. Within the construct of the new market structure, SEFs are a material change to the current bilateral swap market, and if not constructed and introduced to the market in the right way, may undermine the success of clear derivatives as they migrate from the OTC bilateral market. It is imperative that the design and implementation of SEFs is conducive to providing asset managers deep and liquid markets as the current OTC market affords us and allows us to confidently execute swaps on behalf of our clients. This confidence is linked to 1, price transparency, and 2, dependable liquidity, provided by liquidity providers, including our dealer counterparties. We are concerned that the draft rules are focused more on price transparency and less on depth of market. In the context of SEFs, the ability to provide flexible trading venues in the form of block RFQ and central limit book, where the delineation of the different venues is set taking liquidity into account, the ability to RFQ from any number of market participants, including 1, affording an asset manager to get the best price without market disruption for its clients, sufficient delay in public real-time reporting, confidence in a SEF's governance structure, and robustness of a SEF's approved market participants that you meet on the SEF's ability to act as a central portal for trade execution by seamlessly allowing trades to flow from SEFs to CCPs or SDRs, including as new products become eligible, are some of the functionalities needed to support both dimensions of transparency, liquidity and price. Some of these transparency goals are achievable if sufficient time to design and implement successful SEFs is provided. An introduction of SEFs is sequenced after successful migration of clearing of swaps and precedes real-time reporting and block size delineations. This will allow, without major disruption to normal business, transition of trade execution onto SEFs. Liquidity on SEFs would be further supported by providing a risk and liquidity adjusted delay for public reporting, which for some products may substantially be north of 15 minutes. Elimination of the 15-second rule, ability to select for RFQ from any number of market participants, including 1. Without the confidence and the liquidity, we are concerned that liquidity providers will not be able to sufficiently hedge their positions, and this will result in some of the liquidity risk that they currently house to shift to clients in the form of wider bid-ask spreads. In some cases, asset managers may need to slice client trades into smaller pieces, which transfers execution uncertainty onto the client. This is another form of liquidity risk transfer to clients. All these scenarios result in higher execution and processing costs for clients, reflected in investment performances received without comparable additional benefits for price transparency. In conclusion, we would like to highlight we are concerned that the increased risk and costs may cause investors to seek other risk transfer strategies or to transact swaps in jurisdictions which are more favorable in regulation or market structures, which our understanding is not the intent of the Dodd-Frank Act. Thank you once again.
Thank you very much. Mr. Dasso?
Thank you, Commissioner Amelia and Commissioner Dunn. My name is Edward Dasso. I'm the Vice President of Market Regulation at NFA. NFA is a registered futures association and the industry-wide self-regulatory organization for the futures industry. The primary reason why I'm sitting here today is because in the proposed regulations, the CFTC had proposed Regulation 37204, which allows for a SEF to contract with a registered futures association or other registered entity for the provision of services to assist in complying with its core principles. So for the past 10 years, NFA has actually provided regulatory services to a number of futures exchanges on a contractual basis. Our current menu of services focuses primarily on trade practice and market surveillance. We've also provided financial surveillance, background checks, audit-related work, dispute resolution, and record-keeping services designed to comply with the DCM core principles. With regard to SEFs, NFA's role would in many ways be similar to the role that NFA currently provides to futures exchanges that we've outsourced to, or that have outsourced to NFA in the last 10 years. I think one of the primary things that of importance for us currently is getting a data set of elements correct. We've been focusing on that primarily for the last few months once we realized that we'd have an opportunity to provide these services. And we've come up with 174 unique data elements in order for us to feel that we can provide accurate and efficient services to these SEFs. So we provided these data elements to 10 potential SEFs that we've been in discussions with, as well as DMO staff earlier this month, and we've received very positive feedback regarding the types of data that we would anticipate to see on these SEFs. And I know Bill had mentioned earlier in his time that there is going to be, of course, with each SEF, there's uniqueness, there's clearinghouses, multiple SEFs will be given up to multiple clearinghouses. We've experienced that in the past with DCMs, not necessarily giving up to multiple clearinghouses, but we've worked with 4 separate clearinghouses at the same time. And in each instance, each clearinghouse has different data requirements. So to us, it's in order to provide effective services, it's important to wherever possible, standardize data elements and still allow for the flexibility of the SEFs to trade in multiple fashions.
Thank you very much. Bill?
Thank you. Thank you, Commissioner Dunn, and thank you, Commissioner O'Malley. My name is Bill Donovan, and I'm the Vice President of Investments for the United States Steel and Carnegie Pension Fund. We manage in excess of $10 billion of assets for our parent company, United States Steel Corporation, and 2 other plan sponsors. The majority of this money is in our parent company's defined benefit and retiree health care plans. United States Steel Corporation is one of the largest integrated steel companies in the world, and its defined benefit plan has more than 80,000 participants. For the defined benefit plan, approximately 60% of our assets are in equity securities. While this allocation improves portfolio return, it results in an interest rate mismatch. Swaps allow us to hedge this exposure without sacrificing return. Assuming industry-like liability duration, our marginal cost of using bonds rather than swaps as the hedge is in excess of $100 million annually. This amount could be better used to invest in our business and our employees. Given this, it's imperative that we have the ability to utilize swaps to manage the risk associated with volatile interest rates. I'd like to emphasize that we do not use swaps for speculative purposes and only for hedging. In reference to the implementation, we're interested in ensuring that swap markets are highly liquid, efficient, and cost-effective. We are comfortable with the Commission's proposed rules allowing RFQs or order books in effectuating cleared trades, but the Commission should not prescribe how uncleared trades should be executed. We are concerned that the proposal that requires 5 separate quotes may have unintended consequences of affecting prices. Likewise, we are concerned by the lack of clarity around permissible pre-trade communications. We believe it appropriate for price discovery to occur prior to a trade, so long as the execution occurs on the SEF or the trade is posted on the SEF. We appreciate the Commissioner's effort in understanding these issues, given the impact that it will have on steelworkers across the country. We look forward to working with the Commission staff to find appropriate solutions to these problems. Thank you.
Thank you very much. Mike?
Thank you and good morning. My name is Mike Hayes, and I'm a Senior Vice President at the D.E. Shaw Group, a global investment firm, and I'm responsible for our interest rate swap trading within our macro strategy. I appreciate the opportunity to be here today and share our thoughts on SEFs in support of the CFTC's rulemaking process under the Dodd-Frank Act. As active customers of the OTC derivatives markets, we are supportive of the goals of enhanced trade and price transparency and believe that SEFs can be an important tool for participants over time. The ability to transact electronically on multiple platforms will, under the right conditions, democratize access and invite liquidity and competition to the swaps market as it has elsewhere. To be effective, however, the SEF design needs to be responsive to current market dynamics and avoid overly narrow prescriptions that contemplate a finished product. The reforms under consideration are significant and will rely on confidence, and this will take time to develop through technological, operational, and behavioral changes. The characteristics of each asset class also vary, such that trading rules will need to be sensitive to the different profiles of, for example, interest rate, credit, and commodity swaps. There is no one-size-fits-all. By collecting data on swaps activity first, building off of robust central clearing, and allowing for incremental change and adjustment, we believe that the CFTC will establish a more workable foundation. Our hope is that, with adaptive functionality and clear guidelines, SEF trading will develop through market forces. As we do in other markets, we appreciate the benefits of anonymous participation, multiple sources of liquidity, and full trade transparency. While this is a valuable goal for OTC swaps, it needs to be an evolutionary process, and I'll be pleased to share further thoughts on this during the discussion. Thank you.
Mike, can I ask you, you said data clearing execution, or
I'm sorry?
in your statement you said,
Robust central clearing,
but was that clearing was informed by data, is that?
yes. I mean, yeah, so we have, once we have clearing, we can collect data through that.
Okay, clearing first, data then, okay, good, thank you. Rob?
Thank you, Commissioner Amalia, Commissioner Dunn. My name is Rob Houston. I'm the manager of AgriVisor, a small firm owned by a cooperative to help farmer producers across the U.S. manage price risk in today's volatile markets. Been working on a committee with the National Council of Farmer Cooperatives. And, what we would like to see on SEFs is the ability to trade, execute, and clear customized non-standard transactions as it relates to contract size and tenor, options, structures with multiple legs in some cases, and the ability to properly margin those transactions in a manner that doesn't make them cost prohibitive to the U.S. farmer. Our concern is not so much related to the SEFs themselves, but as it relates to the rules, we're not sure if they take into account the unique structure of cooperatives and the cooperative system. And we just want to be on a level playing field with other end users as it relates to managing price risk and not get sucked into the broad definition of a swap dealer. We only utilize swaps for hedging purposes only. And our concern is that increased costs, capital requirements, and margin requirements would make it prohibitive to the use of the American farmer to manage price risk. As far as what the CFTC can do going forward, keep it focused on those transactions that pose systemic risk to the U.S. Financial system. We've been operating smoothly for many years prior to the financial meltdown that brought this bill to the forefront, and feel that we could continue to do so. So I'm very anxious to see what the second panel brings as it relates to being able to utilize SCFs for the increased transparency and the reporting rules that are required.
Thank you. Kevin?
First, thanks to Commissioner O'Malley and Commissioner Dunn and their staff for setting up today and having us all here. I'm Kevin McFarlane. I'm the Director of Rates and Credit Research at TAB Group. We are a financial markets-focused independent research and advisory firm. It seems the industry finally agrees on something. SEFs are good for the swaps market. In a soon-to-be published TAB Group research study of over 140 market participants, everyone from dealers, asset managers, hedge funds, and end users, 87% said that they believe that SEFs would ultimately be good for the swaps market. But of course, in the end, they won't. There's no way that the rules can satisfy everyone. Everyone's definition of good clearly is different in this case. What's important to keep in mind is that the rules and the definition of SEF should not be written to appease everyone or anyone, but instead written to create a market structure that works. And we have to remember back to the early days of Dodd-Frank and why all of this is going on in the first place, and that's to reduce systemic risk. Now, when in that same study, only 60% of respondents said that they thought SEFs would, in fact, help towards that goal of reducing systemic risk. The 40% that said they did not believe it would reduce systemic risk was not just a focus group. It was not just a group of dealers, as maybe you would think. It was pretty widespread across that same diverse respondent base that I mentioned earlier. So what's important here, and it's been mentioned by some of my fellow panelists, is we need to try to not be too prescriptive. Of course, the details around the RFQs and how they should function and block trades are important, But if we think to reducing systemic risk, whether an RFQ goes to 1 market participant or 5, it's not going to cause or stop a bank from failing, which is really what we're concerned about. So the end result should be to reduce risk while increasing liquidity in the swaps market, all while encouraging competition and innovation amongst SEFs and other market participants. So again, I look forward to the rest of the day, and I think we'll all learn a lot. And thanks again for setting this up.
Thanks, Kevin. Wally?
Hi, Wally Turbeville, Better Markets. It's a nonprofit, nonpartisan group who observes and analyzes the process of reform. Thank you, Commissioner Amalia and Commissioner Dunn, for giving us the opportunity to be here. The title intrigued us, attributes necessary for a SEF to be successful. One question that we wanted to elucidate on a little bit is, what is a SEF? What are we talking about? The other one is, what is success? Which I suppose everybody should listen to. I'm going to give you the secret of success. When we talk about a SEF here, let's just to make sure that we're focused. SEF, an organization that provides SEF services, can do lots of different things. The one function we're talking about right now is the qualified execution of transactions that are going to go on to clearing. So that's really what we're talking about here. SEFs can do lots of other stuff, and I'm sure they will. What is success? I think that it's what's important here is that we look at success as incorporating the concepts of price transparency and impartiality. So it would be good, I believe, if we could discuss with a lot of interchange of ideas on how we accomplish those things, rather than just concerned that whatever the rules are now as expressed just don't work. Let's talk about how they might be made to work. Specifically, in terms of impartiality, a concern is often has been articulated by us, that in a world where the success financially of a SEF is defined by volumetric fees, how do we maintain impartiality in that context? Because those who bring volume and attract volume will have a great deal of influence. So that is a concern of ours, and one that can be addressed with industry input. Also with industry input, the issue of RFQs and what they all mean can be addressed too. And I'd like to think about ways we might solve that problem of maintaining the liquidity necessary while still achieving the transparency required. DCMs do that. There are ways to do that. There are ways to determine what is a block trade, is it fairly priced, and go on about our business. As far as RFQs for things that aren't block trades, I would suggest we should think about whether those are just negotiations. Not really. I mean, block trades are actually negotiations well, but they're important parts of the business in terms of liquidity. So how do we accomplish this sort of exception that's really a form of negotiation, but one that provides liquidity as important, and make sure that it's transparent? And last but not least, an important issue I think that we need to address is, as we move into the world of SEFs, quite possibly there are going to be many SEFs in many related products, many exchanges, and how do we address the issue of the high-speed movement of transactions between and among those entities to achieve arbitrage, but not to distort the system. So that's another issue. If it's going to be successful, it has to do that as well. Thank you.
Thanks, Walt. Commissioner Dunn just passed me a note, and he thought it'd be helpful if the panelists were able to question one another, and we're going to have about a half an hour. So before Connie goes, or while Connie's going, think of your questions. You might ask one another. I'm definitely open to having a good, robust debate on this. So, Connie, bring it home for us.
Hi there. Thank you. That's right. Thank you, Commissioner O'Malley and Commissioner Dunn. I appreciate very much the opportunity to speak. I'm Connie Volstead. I'm the CEO of ISDA, and I've been around in the swaps market for a long, long time, primarily as a trading manager, both with respect to my own hedge fund and also within a couple of different sell-side firms. Rather than talk about our comment letters and so on, I thought given the instructions we were sent, it might make sense to just give two examples of how interest rate swaps might be executed once the SEF rules are put in place. I assume that the proposed rules are indeed in effect, and I looked at it from two different perspectives. One would be a small hedge fund. This small hedge fund might want to do a $5 or $10 million interest rate swap, and the hedge fund would not have a typical dealing relationship, but he would be able to get his transactions done through a clearinghouse. The second one would be a larger customer or a larger user, and that would be a large pension fund that might want to do a $150 million swap in 9 years. For these purposes, we assume that the transactions are available for trading and that they're not considered a block trade, and they'd be therefore subject to real-time reporting. So the small hedge fund, he's looking very, very good. He goes into, he can see through a SEF or through his broker exactly what the firm prices are that dealers are streaming, because $5 or $10 million or $20 million would certainly be something that they'd see very, very good pricing on. And so he goes through a central order book and he executes his transaction. He has to post collateral, of course, but I think in the end, this particular small fund would get better execution than he would today. Let's look at the big pension fund. The pension fund is an active user of interest rate derivatives. He looks first at the SEF that has the central order book, and he sees prices for $20 million in 9 years. If he uses this central order book, he'll have to execute transactions in a piecemeal fashion, just as if you want to execute a large trade in futures, you typically have to go and wait and get your execution done, and you're going to take that execution risk. As a result, he decides to use an RFQ. He has many, many different dealing relationships because he's a large user of securities. So he requests quotes from 5 dealers. He knows they are now more defensive in putting their capital at risk, due both to the 5-quote requirement, but also to real-time reporting. He reckons as a result it costs him 1 or more basis points per annum. He marvels that this is the only market in the world where a $150 million trade has to be done on a public platform. It's more than $100,000 a DV01. What are the issues? I think the issues are really, for the smaller users of derivatives, very, very small. And he has to realize now that anybody who's a financial entity has to execute through CCP and has to be aware of how transactions get done. He will not connect directly to the SEF, but he will connect through a dealer. And in general, I think there'll be quite a large number of users that will benefit in this regard. But I think the larger investor pays a higher price for his trade due to the 5-dealer rule and real-time reporting. Then the third thing we were supposed to comment on were suggestions for improvements. And here I think what we should do is start the SEF trading with liberal block trading exemptions that are risk-based. The block trading exemptions in some of the real-time reporting is based upon the notional, whether it's a 1-year or a 30-year. If it's $250 million, you have to have report the actual amount. And increase the reporting delays. If you start off in this manner, you can always tighten up the requirements in the future. I think it's also important to be less prescriptive, especially with respect to things like the 5-quote requirement. I'd like to say one other thing here. I know we have a lot of potential SEFs in the audience, but I think those SEF participants, and indeed I think the Commission should do a comprehensive cost-benefit analysis. We took some numbers out of the SEC proposed rules on SEFs, and we estimate, and they assume that there were going to be 20 different SEFs, that we estimated that the cost would be between $140 and $240 million a year. In the interest rate swap market, we think that today there would only be about 500 interest rate swaps per day executed on a U.S. SEF. If you look at that, and we also think that the buy side will probably only execute about 100 trades a day on a SEF. So if you look at the cost per trade, given today's volume, it would be about $2,000 per trade. And we also think that for larger trades, there would be less aggressive pricing. You need an explosion of trading, and this would be an explosion of speculative trading for this, for that activity to support 20 SEFs. That's it for me. Thanks.
I'm going to start with you, Connie. I'm really interested to understand these numbers a little bit more, because there are a couple of factors that at play here. There's cost and schedule, but you referenced some numbers, these SEC numbers of 140 and to 240, and then obviously some of the volumes. I'd be interested if you could expand on that a little bit more on where the SEC cost estimates are, and then maybe ask the opinion of the panelists here if you have a different take on that.
Sure. We looked at pages 346 and 347, believe it or not, of the SEC rules, and they looked at the costs per SEF for technology, and for instance, they say that the technological costs would be expected to decline considerably during the second and subsequent years of operation. We estimate they'll be in the range of $3 to $4 million per year. That would be for a new SEF. For a SEF that is an adaptation of an existing platform, they reckon that would be $1 to $3 million. Then they say there's a ongoing compliance cost of about $1 million a year. Annual cost of maintaining the technology and any improvements is $2 to $4 million a year. They don't talk at all about management. They don't talk about rent and so on. We add another $2 million a year. But if you divide our first amount of 140 by 20, it's $7 million a year. I don't think that's a wild number at all for a SEF to be for their costs, and the larger number is in the neighborhood of $10 or $12 million a year. So the numbers that the SEC quoted were numbers that SEF developers gave them, and they're rough numbers, but they're orders of magnitude that I think you're not going to get away from.
Okay, that's helpful to understand where some of those numbers came from. Kevin, you've been looking at this. You have a different sense on that?
Well, I actually wanted to comment on Connie's points about the trades per day and what we would expect. Under today's environment, that all makes quite a bit of sense, but thinking under the new market structure where we'll have presumably many more market participants, spreads will ultimately get tighter, trade sizes will get smaller, and based on the same survey I mentioned earlier, 75% of people said that the notional turnover they saw would absolutely increase. So the outstanding notional will grow slightly, but the turnover will grow considerably.
I do think you'll see more transactions, that's for sure. But I think the costs of executing a swap it will be quite a bit more than executing a 10-year future. I used to run trading desks for a long, long time. And what you want to do if you're going to be a trader is you want to get in and out of the thing that has the most liquidity and also that has the cheapest execution costs. That will not be an interest rate swap. There will be more people executing swaps, but most of the people that execute swaps execute it for a reason. It's not just strictly to trade. So I think there'll be greater volume, but if you double or triple the volume, fine. But it still means the whole operation of the SEFs is going to be uneconomic at 20 SEFs. It would work with 2 or 3 SEFs, I think, for interest rate swaps anyway.
Having developed software to access market is part of my career. I ran a company that did that. The whole issue is, as you think about building a business like this, is your decision, your main decision is, am I going to harm my company by building a system that won't attract volume? So it is hydraulic to a certain extent in the sense that SEFs who are going to develop their businesses, there will be 1, 5, 20, whatever is going to happen will be based on the assessment by SEF management to determine whether the volume will be there to support what they're doing. So that is, I think it will be sort of organic and hydraulic as to how this will all work.
Well, and to the price per trade point, right? That's what the competition will bring. That's why we have so many SEFs in the room, and that's not going to happen tomorrow. That's probably not even going to happen next year, but if we think 3 or 4 years out, there's going to be such fierce competition to get a lot of that flow. The technology innovation will help, and then just sort of natural competitive forces will drive prices down.
I think one should also, I'm sorry, Bill, if I may, one might ask what compression of spreads for collateralized interest rate swaps do you expect? And ask the large buy-side guys, because it's going to be very, very small. We did a test a year ago or 9 months ago, and the execution prices were 1/10 of a basis point over mid-market. They can't get much tighter than that.
Thank you very much. In my comments, I've tried to stick to what I thought the outline was, which is what's important to SEFs, not about some of the rules. What I'd like to stress in that is we should separate out the difference between the futures market and the swaps market. Over time, I agree that you will see a convergence and more people trading, more liquidity, and a more futures-like market where there are market makers and people who trade algorithms and other things to take advantage of small price fluctuations. However, you were talking about a market that has grown up in what I call the upstairs market, where the trades for the vast majority are block trades. The liquidity required is analogous to dark pools in some extent, and also it's dependent on not having instantaneous discovery to everybody, because not everyone can participate. You're also talking about a market that for the vast majority of people in this room, we are not legally allowed to trade unless you are an institution or a qualified person, whereas the futures market is dramatically different. So there's a whole host of things that are structurally different about the market. I do believe in the fullness of time, as SEFs develop, as there is more market making, as there's things, that the electronic markets will converge to be closer to what we currently see in the existing futures market. However, this is going to be a transformational change that takes time. Doing it cold turkey will have adverse effects to the end users, and that is everyone at this table, which will cost their clients money. I have a fiduciary responsibility to my clients. Many of the people here have fiduciary responsibilities to their clients, or they are the client themselves, and it's going to cost their business money. So I'm not meaning to speak for them, but that's how the market structure works. So my concern is that saying things that SEFs will instantly work, and the fact that there are a ton of people willing to provide SEFs and make them low cost is wonderful. But what's important is not that we have great functioning SEFs in and of themselves. What's more important is you have great functioning SEFs and the users willing to support and participate. Because you can have a SEF with a bid ask of 20 cents or 50 cents. It doesn't do you much good if the upstairs market is 1/10 of a basis point and you're now paying half a point. So I just want to stress the difference that, and I think people touched on this, it should be a general rollout, and the points Connie made about starting with wide block trade limits and letting this move over time, I think will be the least market disruptive to people. It will allow people to get comfortable with SEFs and what they offer, and it will move things in the right direction, which will ultimately provide the transparency to the end user that everyone thinks is ultimately a good thing, but it should not be done in a way to cost end users currently large sums of money, because at the end of the day, the dealers or the liquidity providers will charge the end user. It will not be the other way around until you reach critical mass.
Well, I think there were several people around the table, the majority of the people around the table talked about developing flexible rules, and I think that was code for there are a few things in our rules that are not flexible, and some people mentioned them directly, the 5-second or the 15-second, sharing the 5 bids, and then obviously this block trade thing has come up again and again. You mentioned it in competition. Connie mentioned it in a risk-based sense. Let's take these 3 issues on directly, and your concerns with any one of them and what impact it will have. And I suspect, we obviously separated the users from the SEFs. I suspect we're going to hear much of the same thing later in the day from the technology providers and the platform. So I'd like to just confront these inflexible rules that we've proposed and get your thoughts on them. Sure.
if I could piggyback on that a little bit, because in listening to the panel in here, there are probably three things that I heard most often. One was transparency, the second was liquidity, and then uniqueness. And that seemed to be an overarching theme that I heard over and over again. And as what we're used to at the CFTC is a principle-based regulatory regime in which we say, here are the principles that have to be out there. You tell us how you're going to conform to those. As I listen to the group around here, there seems to be a dichotomy of thought of, well, are we talking about revolution or evolution as we go through? And that goes into the implementation of how we go about promulgating these regulations. Now, personally, I would hope that we're able to do something that is less prescriptive, but is also with the understanding from everyone that is going to be evolutionary as we get into this and we begin to understand more and more about what's in there. And that would require us to be writing some guidance or safe harbors for folks so that they understand what their expectations are from the CFTC. That argues for us to have the staffing ability to do it. I have to get that little add in for us. However,
I think we just have authorizers here. We'll just do that.
The bottom line, though, and Ed, I'd like to get your thoughts about this. How do we come up with something that allows us to be evolutional, but still gets back to the fundamentals of what Dodd-Frank is all about? And let's just put it right out on the table. Everybody thinks that it's over-the-counters. We're the big culprits there. So we need to be responsible to ensure that we don't have that meltdown in the future.
All right, thanks. So prior to coming back to NFA, I had spent the last 2 years at ICE, and my primary responsibility at ICE was setting up the OTC Energy Compliance Department for contracts for swaps that were deemed to serve a significant price discovery function. So, of course, I'm sure everyone in this room is probably aware, there were 9 core principles that were very similar, designed after the DCM core principles that are currently in place. So along the lines of what you're referring to, Commissioner Dunn, as far as the evolution, that is, in a sense, it's the original SEF, so to speak, as far as being successful and having liquidity and volume. We had to put a rule book, a future style type of rule book and regime in place for a market that had been operating 10 years. Without those types of rules. So the challenge that we had was to try to ensure that we complied with the core principles, which I believe we did, because 3 times we demonstrated compliance for natural gas contracts as well as for power swaps. But one of the rules, two things. First, we didn't put a block trade requirement on those any blocks. There wasn't a minimum, other than, I guess, the smallest lot size that would be allowable on the exchange. The thought process there was we actually need to see how this actually impacts the marketplace, the rules for trading standards. And the second rule that we spent a lot of time in focusing on was position limits. So a lot of those swaps that traded on ICE, of course, actually all of them at the time did not have position limits. So, and there were historical clear positions that were out the curve 6 years. So a large concern that we had was, if we put position limits on these contracts, how are they going to impact people that had positions on prior to the fact, that understanding that there would be position limits in place. So a phased-in approach was the approach that we took with the position limits. So once a contract was deemed to serve a significant price discovery or SPITIC function, we determined what the appropriate level of, for like say the Henry Hub, of course it was mandated that we adopt the NYMEX level. But for the power contracts, we actually did research and determined what in a market that was very difficult to do what deliverable supply was. But we didn't put it in place on day one. We phased it in over time and worked with people that had historical positions to ensure that, because the most important thing wasn't necessarily that someone was, say, in violation of a spec limit, but we had orderly liquidation of positions. So that was our primary focus, was ensuring that if someone had to reduce their position or apply for a hedge exemption, we did it in an orderly fashion.
Can somebody speak to the issue, the evolution approach on block trading, and how we're going to make block trading and SEF relationship work so SEFs are successful? Anybody want to address that, Superna?
I'd like to hear that with all three of those regulations that you
And the commissioner just said he'd like to hear on all three, the minimum sharing of 5 bids, the 15-second rule, and block. So if you have an opinion on that.
I think, in all three, they relate to liquidity. So, I'll address, your question first on block size. I think block size and introduction of that is more on the evolutionary front of when we introduce it and what that size should be. So I think we have to be careful at what stage of market structure we introduce it. It's important that, from an asset management perspective, you have the ability to liquidate big size and big risk transfer trades, which is why how we determine that block size and what confidence the market has, once that size is put in place is very, very important. On the second point, related with the minimum of 5, again, that is more a concern of how much information is out there when you're going to be doing a big risk transfer trade, and how will that impact the pricing you receive from your liquidity providers? Because if you have to send it out to a minimum of 5, the winning provider knows that there are 4 other out there that know that information. And that's why I think that, the recommendation is allow us to make that choice so that we get the best price for our clients. Because in certain situations, you will go out for 5. But there'll be certain situations in which the best way to get the best price is that you go out to one liquidity provider. And on your third point on the 15-second rule, in my opening comments, I basically had recommended elimination of that rule. And, I would like to, have an opportunity to maybe ask Dexter how the bid ask would be impacted if that rule were to be put in place. Because, our understanding is that if the 15-second rule were to be there, it creates uncertainty of trade execution. And for the liquidity provider providing us that price, there's no upside into giving us a better price when they're basically on the hook after all other market participants can improve on the price.
Well, yeah.
Just a question on the 5 bids. Clearly, the 5 bids are the 5 targets for an RFQ are designed to create some sense of transparency. I'm just interested in let's take as given that an RFQ for a block size trade, however that gets defined, maybe now, maybe evolutionarily, whatever, needs to have some transparency of price. 5 will do it. It may not work in the process. That's what you've argued. I might disagree. But how would you approach creating transparency other than the 5? Is there a way to
transparency of price for the
for
person
for a
requesting
block-sized
the quote?
RFQ, similar to the process in exchange-traded block trades where there are standards around price?
Well,
I see about 15 guys out there raising their hand about how they want to answer your question that are going to have the opportunity to provide that. If you want to respond to that, but I think most of them are coming loaded for bear on that question specifically, saying, this is how you get price transparency, and I think that's what we should watch for, and that's probably a good one. Dexter, you want to respond to the 15-second?
I'd like to thank Superna for giving me the argument I would have made had I even bothered to comment on that 15-second rule in our comment letter. It's a complex issue, and I think you put it best when you simply said that when you remove either dealers' incentives to provide best price for a lot size that they can have the security of knowing that it's an all or none situation with reasonable reporting. Well, those are the conditions you want. That's what engenders best price. And when you start exposing too much information or expose it too soon or introduce any uncertainty about the transaction to either side, prices and spreads tend to get worse. And I agree with your comments on block size. As far as the greater than 5, the point we made in the letter, which I'll make again, is that we're not telling people that they shouldn't go to 50 if that's what they want to do. Go to as many as you want. But our customers are pretty sophisticated in terms of knowing what number makes the most sense for the size transaction they have. You guys have a tough job. As a regulator, you have to decide some rule at the end of the day that defines what a block is. And then transactions will be blocks or they won't, and it's binary. But the real world's not binary. The real world is a grayscale. There are small transactions, medium and large, and the larger the trade gets, the more dangerous it is to show it around. And I think that point is very well understood by the people in this room. So our only point is this is an institutional market. The players are sophisticated. Let them decide.
Bill?
Thank you. I agree with Superna's points, and I sort of just wanted to elaborate more on your question, Commissioner Dunn. You sort of asked how do we avoid the situation that occurred and why are we in this situation? And I think that this leaves the land of the question that we're at here just on SEFs, but it's one of sequencing and what's important. And I think first and foremost to achieve the limitation of systemic risk is going to be clearing. Clearing in and of itself will be the important thing. The second thing that you want to think about is price discovery. Price discovery is one of where are things priced and who has access to that. Not necessarily real-time pricing for everything, but end-of-day marks, fair marking, and that information. One of the reasons we had problems was people weren't marking things fairly or they were hiding their marks and not posting collateral. Having CCPs and end-of-day marks accomplishes that. The next things that I think are good for the, our common goods and what we're trying to achieve here is better price discovery for everyone so that it's a more playing field. Certain players have more information or better information or more expertise. The more expertise thing is a function that you can't equalize and you shouldn't try to force that. However, the access to information, you do want to over time increase and make it better so that people are getting the best executions. So, but as Commissioner Amalia mentioned, this is going to be evolutionary, as did you, not revolutionary. And I think that forcing things through is going to be the problem. So if you have an institutional market that tends to trade upstairs and migrating it, you want to do that in a meaningful fashion. What, as Mr. Sense said, is important is we're sophisticated players. We understand the ins and outs, and there's gaming, and there are things that happen. But what we want to focus on is if you set up a market structure where people who want liquidity, i.e. someone looking to transact and asking for levels to trade on, are forced to give away options. They're going to be charged for that, and that's going to hurt the end user. So as Superna mentioned, the winner's curse. If I need to show 5 people or I have to show 50 people, that changes their natural reaction to what they're going to show me. If I ask you, can I buy your house? You're going to have a level for me. If I tell everyone in this room I'm going to buy their house because I need to buy 500 houses, the price for those houses will go up for me because everyone knows I'm an insensitive buyer. Price is not my point. I need to obtain these houses. So by going out and saying I have to do a trade and telling 5 people I have to do this trade, their incentive to be competitive changes. Also, as Superna pointed out, the person who wins the trade will know that other people have that information and they can use that information against them. So the time delay by making people wait is an option that's been sold, so someone's going to charge you for that, as well as the fact that when you give the liquidity, other people will have that information. It's not a private negotiation now. They will use that against you as well. So I, as a market maker, or I being asked to provide a price, will not be as aggressive because I have these other things that I'm effectively shorting. So I want to be less competitive. So that's why we're very concerned about these things, because they move away from the current market where there is full transparency is not obtained, but but you do have transparency and you can transact more quietly. At the end of the day, there is price information. So I think hopefully that answers your sort of question about migrating along a path.
Gary?
Sorry, I just wanted to make sure one thing was really clear, is that when you get especially into power markets and the power swap markets, is there's actually a little bit of history in the OTC markets, as well as some futures contracts that have been proffered before that actually failed in terms of gaining liquidity. And the reason is that they weren't matched up well with the actual risks, the underlying risks that we're trying to manage as producers of power. You have extremely discrete points, in terms of, take a market like PJM, which covers, approximately, the Northeast states, kind of the central part of the Northeast. Right now, today, there's a much more greater liquidity level in terms of swaps I can transact at PJM West than there is at PJM East. I can barely get a trade-off in PJM East. So, especially in the conversation of SEFs and the like, from somebody that owns some PJM East, assets, I'm much more interested in how am I going to get liquidity that doesn't exist there today, and how is a SEF, potentially could help me create that liquidity. I hope it does, but the market's already told me, and it's a very robust market, a lot of participants. So far, it's never gained ground before, so why would I expect it to change today? That's kind of one of our key questions.
Let me just ask a question on kind of a chicken or the egg issue. With all of these SEFs coming up, does listing a contract on a SEF facilitate clearing, or is it going to be the other way around? You guys have an opinion about that? And is it going to be clearing driven? I think some people said that clearing is going to be the answer. And as we put our rules together, I want to try to get a sense of that.
Yeah, this is Connie again. I think the clearing is the be-all and end-all virtually for reducing systemic risk in the marketplace. I think right now in the interest rate swap world, there's about $250 trillion of interest rate swaps that can be cleared. And there should be a big push to clear more swaps. And by that, right now they can only do plain vanilla swaps, but we should be trying to do FRAs, swap options, caps and floors, and so on. And if you can get that and you get the buy side onto clearing, you'll probably be clearing 80 or 90% of the derivatives market. And I think you'll be taking the systemic risk right out of the market. And for the more liquid products that are cleared, I think you can then migrate them onto SEFs. But I think clearing is the first part. And I think SEFs are there to make the market more transparent and probably more fair if you think they're not fair as they are now.
Yeah, Mike?
Just to add a little bit to what he said, I mean, I think particularly if you imagine trading interest rate swaps on an order book where there's anonymity, I can't do that really unless those swaps are cleared. Otherwise, I'm taking on credit risk and counterparty risk that I have no idea what it is. I just can't do it. So, unless those instruments are cleared, there's just no way we can develop that on the SEF.
Dexter?
Scott, I think if a literal interpretation of your question would have to be answered that the clearing of swaps will drive the SEF activity because it's what generates that mandatory execution requirement in the first place. But the fact is that many of the platforms out in the marketplace today, and that we're going to hear from later today, they're in the business now of electronic trading. And as SEFs are created and some of the trading that they do now is labeled as SEF trading, I can't help but believe that this makes all electronic, it raises the bar in terms of what electronic markets are capable of. I'd be very surprised if the new techniques that we develop for swaps don't leak out into other parts of the market. And as a person who runs an electronic trading business, it's a bull market for that style of trading. A lot of that trading won't technically be labeled as SEF trading. So, again, literally, I think it has to be clearing leads to SEF trading. But the SEF trading itself will create more electronic trading, which is, in the end, good for what you're trying to accomplish.
I guess I can add one more thing to that. I agree with everything everyone said. The reason why clearing is so important is if you have SEF trading without the clearing, then you still need market participants in most cases. With all of that is the documentation and all of those agreements, those bilateral agreements, and the clearing is what makes or takes away some of that complication once it's all in place. So certainly I think we will see, as people find new trading strategies for these products as they're traded more electronically, that will then lead them to look at other products that they can sort of add to those strategies, and it'll be a good thing. We'll see more electronic trading across the board in the long run.
Just a quick question, Kevin. When in your presentation, did you say that you've got a study that's going to be coming out soon? and let's don't wait too long.
No, within about a week and a half, we'll put it out.
It would be very, very helpful if it would send it to us. I've asked all along that we get empirical data. Wally, I just got something from you guys a couple of days ago. I really appreciate seeing that type of research. It helps us to make up our minds as we're looking at these proposed regulations. So, and that goes for any of the other panelists. If you've got some studies that are coming up, it would certainly be beneficial.
Yeah, we'll certainly send them over.
Well, we are at our break period, and we will get on with all the presentations going forward here. I greatly appreciate everybody's participation and contribution here. We could probably do this panel all day and still have plenty of more things to discuss. But we do need to get on to the platforms and looking at this. So we're going to take a break, a 10-minute break. 10-minute break, start at 5 after. This panel is excused. We have some seats off to the side here, and I'm going to invite, so we can see, Commissioner Dunn and I are going to slide around, and we have some CFTC staff that I'm going to ask come up to the table if they want, and so they can maybe ask some questions occasionally if we see something we have to know.